All right. Hey, gang. This is Toni Hansen. I want to thank David and everyone for inviting me to join you all here this evening or afternoon, if you're like me, on Pacific time. Um, a little bit of my background. I've been trading since the mid 1990s, and I started as a stock trader. So I've done a lot of trading in a lot of different markets over the years. I was originally a swing trader and doing more kind of multi-day to multi-week holds in individual securities. And over the years, I was focusing a lot on what was happening in the futures markets, just as a general direction for the overall market trend. And I started getting into doing more day trading in the futures, as well as doing a lot of gap trading and news type of trading in the stock market. And since then, I trade Forex and gold and oil and all different sorts of things. These days, I trade primarily the futures markets. So currently, that has lately encompassed mostly gold and the ES. But definitely, Dow, NASDAQ, oil, those are all things that I focus on. Um, the kind of cool thing about my style of market analysis is that you don't really have to know the market that you're trading. You just have to know technical analysis. And when I started trading in the 90s, there wasn't a lot out there as far as technical analysis went. So I basically am self-taught along the way. And I come from a background in the arts and archaeology, and um, so patterns and pattern analysis was kind of second nature to me. I found it easy to make sense of what was going on in the markets. And what I'll share with you today are some of the things that I look at that are really easy concepts to hopefully grasp and take and apply to your own trading, as well as kind of how they all work together. So I was going to show you, go through a PowerPoint really briefly, but I'll kind of do a mini version just using this chart here of Dell as an example. So a lot of traders these days, they have a little bit of background in things like Elliott wave analysis and um, basic market trends type of stuff. So some of the things that you'll see from me in my trading are very similar. I ran a full-time trading room for a good, I think it was like about 12 years or so. Um, Kind of got burnout being here and providing content all day and trying to trade at the same time. So I started going into doing more working with individual traders on their trading and helping them um, break out in their own um, careers, as well as doing more of like the course type of work and teaching the things that I'd learned over the years to kind of help you guys shave off some of that learning time. I know it's really hard for those of you that are coming into trading now, especially because there's just so much content out there. It's like it's the complete opposite problem I had when I started. For me, there wasn't enough information out there. What there was really basic, buy a 5-day pullback in an uptrend to a 20 period moving average, for example. Well, of course, you do that enough times, you're going to figure out pretty quickly that that's not going to work as a very stable solution. So there's a lot more that goes into a pattern and a strategy in terms of how it's developing to create a stronger setup. And over the years, I developed a system of market analysis that I call building blocks of price development. And basically, they focus on some really simple ideas, but they tend to get pretty advanced in terms of how they are working together. So basics start out with just, pure trend development. One easy thing to look at and understand are things like impulse waves. So these are, just the primary directional trend moves in a security. Dell here is kind of a bad daily chart to show you because you've got this big upwards development in terms of the price action. But in most markets, you get a lot more back and forth type of action. So you can really compare what these average impulse moves look like. I tend to focus on trends more as two-step patterns as opposed to Elliott Wave's typical three-step analysis. And that's because when we're looking at a trend that is forming, certainly you're going to have examples like this where we do have the three-wave trends development. But in a lot of those trends, you'll see differences in the size of that middle wave. So sometimes your first wave will be short, your second wave will be really big, your third wave will be smaller. Your first wave might be bigger, second wave weaker, third wave weaker. So you'll see all kinds of different shifts in the way these trends kind of unfold. And so what I'm often looking at is this action here as the two waves of correction that are taking place. So if we look at typical like Elliott wave type of correction, you're usually looking for a two-wave type of correction. And when we're comparing impulse waves, it's really important that you focus on the momentum of those waves. So if we see like a 30-point move in half an hour, if we're really wanting to look at a comparative type of move, we also want to look at about a 30-minute time period and something where the momentum or the pace of that change is about the same as we saw in the previous trend. So if there's any changes in the momentum like we see here, then that can impact the type of action that we see after it. And one of the things that is happening in the market right now is that we are at the extended levels of impulse moves on bigger time frames. So we're seeing a lot of really larger time frame trend exhaustion, which usually leads to what I call a widening up zone, where we tend to get a lot more back and forth action. The range widens up usually, and usually it's a good market for swing trading type of moves, as opposed to like the trend today, where we had a really grinding market throughout the session, which actually makes it a harder um, day to trade if you're looking for smaller time frames intraday, because you don't get as clean of corrections and continuation types of setups. So if we look at the Dow, for example, here, you can see that for a huge portion of the day, we really just had this grinding move up where the trend is really choppy. If we look at this in terms of impulse moves, we have a number of them that we can use as kind of these shorter little comparisons. So you've got that first initial break. This is our midway correction. And then we've got that measured move as a continuation. And you'll notice that the momentum on this first move is about the same as the momentum on the second move. Now, in both of these cases, the momentum is stronger than average. So what that means is that if you're looking for a reversal type of strategy when you hit that measured impulse move, when you get to that resistance level, it's a strong resistance level, but you're not necessarily going to get a trend reversal going into it. So what can help you have an easier trend reversal is going to be something where the momentum starts to shift. So, for example, one of the typical strategies that I will look for in the markets is called a momentum reversal. Actually, see if I've got Telegram open here, and it might not be able to pull it up. But let's see here. This is kind of a little bit of a version of it here on the NASDAQ. This is the micro. What you're basically looking at is the impulse move to start with, and then basically three lows. So you're looking at this shifting in the momentum. Usually this impulse move here is a two-step move that's a little bit stronger, so a little bit bigger, a little bit deeper. And then that triggers a reversal when the channel breaks over here. The PowerPoint I was going to share with you, I was going to show you how to use Fibonacci fans. Fibonacci is really one of the only indicators that I use in my trading just because it works so incredibly well. And you don't have to have like some deep background knowledge into indicators to be able to use them and to learn how to use them correctly. With Fibonacci fans, basically what you need to have is an average to slightly stronger, slightly weaker than average momentum move. So if you're trying to add a fib fan to an extreme impulse move like this, for example, it's not going to work well to give you support levels. Let me show you what I mean by putting that on there. So you can see that as this comes down, that dark green line at the very bottom, that's a 76.4% Fibonacci fan retracement. And when we're looking at the momentum on that trend, we need to have something that is more gradual, where you see more overlap within the trend and then the shorter little bursts of upside. So something that is an average momentum move, you're going to be able to use your fib fans on. The one here this morning, or sorry, this evening, is actually another example too, where it's a pretty average momentum move. So if you're going and looking at that, then this is another one that would come into play. There's actually one type of adjustment that I will use if something is kind of borderline in terms of the momentum, where if you're looking at the first drop, let me remove some of these here. So if you're looking at this first drop, if it does not stall at either the 61.8% or the 50% fib band, if the pullback is more than 50%, then I will move the fib fan to hook this up with the 61.8% fib fan level. So this is one of the adjustments that I've developed over the years, noticing, hey, how many times does it not hook up or stall at one of the major fan levels? And yet, if I do certain manipulations, in which cases does it work consistently over time? So what I found is that if I have a really extreme momentum move going back against that primary trend, and the pullback is more than 50% before it stalls, if I'm looking at this as a two-wave correction, I can take my fib fan and I can drag it down to hook up that first low with the 61.8%. And what you'll notice is that that then gives me the 76.4% as a support level to start to look for reversal patterns. So this is something cool that I discovered. I guarantee you nobody else teaches this out there. And um, it's one way that you can manipulate your fib fans in certain circumstances, but you have to use that rule where if it's a sharp pullback, more than 50%, hook up that pivot low with 61.8%, and that's going to give you your next support, which should be your 76.4. And that's usually where I'm looking for reversal strategies, which are typically a continuation of the bigger trend here. So for this afternoon, for example, it was the fan level here, and you'll notice that it did pause close to that 50%, close to the 27.2, close to that 61.8. So there was no need to adjust that smaller fan over here. It was already holding those initial fib fan levels. So this was one of the things that kind of helps me with the direction for trading continuations here going into the end of the day. But it is something that can be used anytime in your trading. So you don't have to use it on the NASDAQ. You can use it on individual securities like Dell, or those of you that are trading, things like Tesla and whatnot. It's just a really handy tool. So a trend like today, though, where we don't really have much as far as deep corrections, your fib fan's not going to be as useful. It's going to be a situation where you're not really going to be using it because you're not getting long enough pauses in that upside move. So one of the other things that you can look for kind of to help out with trends development and understanding, like reading trends, is to look at the correction periods in a trend. So if you've got two correction periods lasting about the same amount of time, for example, on gold, let me see where my chart of gold is at here. This was something I was looking at the other day. Find the right time for right here. So I was looking at this trend in gold for continuations on the upside in gold. And what you'll notice here is that there was the initial impulse move over here. Then you've got one wave of correction. Well, as this was heading into overnight trading, this was offering the same size of correction as that original correction. So what that meant was that there would be a very high probability that I would get a third move where, as long as this correction is still more gradual than the upside here, I can get up to a measured move compared to here. Now, the first level that I want to watch for as resistance is going to be right here because that's the smaller measured impulse move. And that hit pretty early in the day. But it does leave room open for it to offer that bigger measured impulse move. And notice the key traits here are that the momentum is the same. So this was one of the things that we were looking at in these days. I teach a live class at noon every day. I don't do like the full trading room, but I do live analysis every day at noon. And so usually when I'm giving classes, I'm pulling from my own trades or things that we've discussed over noon to show how they play out in real time. This is one of the things that we've been looking at here. Another example of this, pull up here. I want to show you what happens when we start to go into those measured moves. So if you look at this 120-minute chart here, you can see that this impulse action is substantially stronger than average. So on the smaller time frame, we were able to see those waves really clearly. But if we look at this on this bigger time frame, these are just really rapid upside movements here where we're going into what I call the widening up zone. And that happens especially when you've got a stronger than average impulse move, or if you have impulse action in a security where it's just kind of taking off like a rocket, or well, not really like a rocket, right? Like more like an airplane. So if it's taking off at like this angle and building steam, in those initial corrective moves, that's where you've got your highest risk because there's so many different ways that that can play out as it goes into a widening up zone. You can get something where it starts to shift momentum like this, and this does those three pivots for a momentum reversal, like I was sharing with you on the NASDAQ. You could get something that has like a steep correction where it goes into more of a trading range, like what we have here on gold. But you could even get something where it comes down and goes into a pattern called an avalanche, where it basically is shifting the momentum again to get selling. So you've got stuff that can go any direction when you're going into a widening up zone. And that's one of the things that a lot of traders are having more difficulty with right now in the markets because on our weekly time frames of the indices, we are at these extreme levels where we started to go into more of that back and forth type of action on monthly timeframes. So we're seeing that playing out with much bigger swings on the daily and weekly charts right now. And really, that just means watching the smaller measured moves to help identify exhaustion. So, like on gold here, as you know, the week progresses, I'm not going to be as interested in what's going on the bigger time frame because This bigger time frame already has a lot of measured impulse moves. So it's already showing me a lot of exhaustion with the trend, but there's no shift in the momentum. So that can mean that at this point, this could still push and do another move up. It could go and shift momentum. We could begin to get more of a rounding off. I think that's going to be trickier. Um, we could even get something that has, develops into a sharper correction like what we saw over here, where you also had those two measured moves up. This is the start of your widening up zone because that's where you've got that measured move at. But in this case, you get a little bit of rounding here and it went into a smaller shift in the momentum that changed it to larger selling. You see kind of a little bit of a shift over here too, but it makes you go down to the smaller time frames to look for those setups because they're not really visible on this bigger time frame. So if you're looking at a lot of different stocks at the moment, you're going to find that a lot of them are in this general phase of things. One of the setups I mentioned was one that I call an avalanche. And that is what triggered the sell-off to continue on Dell. So we've got this huge gap trap here on Dell. But then you'll notice it went into that little two-wave correction here. Well, this is the avalanche. So one of the reversal strategies that you guys can look for in the markets right now that's really strong. We actually had one on gold too a couple weeks ago, smaller than the 120, but is look for an initial correction off of the high where ideally you have two waves of correction in it. And then you're going to look for another two-wave move that's a counter trend move. Look at the spacing between these lows. So A and B should be about the same size. And then this pivot high here, if we use a fib time extension, we would want this to be at the 61.8% or later for the fib time extension because we want it breaking here right around 100%. And if it's earlier than that, what can happen is it can shift the move like this. So you actually end up with something that goes higher instead of something that breaks lower. Oftentimes that will happen where you'll have A and B about the same, but it won't quite hit that trend line here. So you'll have this slower shift, and that will lead to the stronger break higher again and offers a really good buying opportunity. So when you're first coming off of these highs, you don't know which way that trend is going to ultimately end up shifting. You have to wait for that kind of final shift, whether it's the red one with the 61.8% pivot high or later, or the blue one where your pivot high is much earlier on the time extension, meaning from 1 to 2 compared from 2 to 3. So if those are the same, if your pivot high is later, is 61.8% or later, your odds are better for a breakdown. If it's before, then it becomes more random. But if it's before 50%, then it's more likely to break higher. So this could have shifted here on Dell and gone into a move like this that would have created a move on the upside instead. So this is one of the patterns, well, two of the patterns that you guys can watch for in individual securities right now that can offer really good setups as swing trades in today's market. You're lost too. Okay, don't worry about that. Let me slow down and review a couple of the ideas here quick. So my background, obviously I've been trading for about 25 years here now. So a lot of the people that come to my classes, they've been at previous classes, so they know a little bit more about my style of market analysis. And like I said, I was having a little bit of connection issues here as we were getting started, so I wasn't able to pull up the PowerPoint. But what I'm trying to share with you are just some basic ideas that you can pull and go and look at in the market. So one of those ideas is to think of trends in terms of two waves. And those two waves are often sets of two. Now, what you'll often see people do, though, is they'll refer to trends as waves of three. And what's really happening in those cases are during these little corrective moves in a two-wave trend, these are kind of lower, these are lower lows that will be happening, right? But if it is in a stronger trend, you might get a halfway move where it is half of that orange correction, and you'll end up with three waves instead of two. And those three waves can have these little smaller two waves in them, and the orange ones can have little two waves too. So we're thinking in terms of it, in a trend, what's our wave count? So if we look at the trend down here on Dell right now, you've got 1, 2, 3. So the key thing here is that this correction and this correction are about the same size. They're within 1 to 2 bars of being the same size. So what that means is that this is now an exhausted trend on the downside. It's going to be harder for it to offer a continuation of that trend if it only corrects that same amount of time. So what that means now is that the market is more likely to go into what I call a widening up zone. And in that widening up zone, those early levels of back and forth action are less predictable. So what you have to look for are smaller shifts in the momentum coming off of those initial pivots. So on Dell, for example, one of the strategies, and this is something you can apply to anything, is if you do get a sharp initial move, ideally this will have two waves, but on Dell it had a gap. Look for a two-wave correction against that original move where the distance between these A and B are about the same size. So if we look at Dell right now, what that would mean is for an upside move, since we've got three waves of downside here, an upside move could look like this and then get two waves of correction and then offer a buy setup, which would be a Phoenix setup. So in these early stages of widening ups, this is one of the patterns that can happen. What we have to watch for, though, is if this doesn't have as shallow of a secondary pullback. So if this is your first upside move off of the low here, this little arrow here, purple, if this is our first upside move and we're wanting to get a continuation of that trend, then a pattern that I would usually look for would be a phoenix, which is the opposite of the avalanche. So that consists of a two-wave correction. Typically, those each have two waves within them. If they have three, then it is because the corrections are smaller. So you might get three waves down here and two waves down here because this bounce is adding this and this together. So you often in Elliott wave, you'll see this pattern here with the three waves. But I think of it in terms of two waves where they have two corrections. And that middle zone can be many different sizes. So it can be this middle portion right here, or it could be longer, like over here. So for Phoenix, the buy setup on this would be a breakout right here. And that would trigger the long side. Now, if what we saw happen was a change in the momentum, though, where if we're looking at our distancing between our highs, this is going to be A and this is going to be B. Oops, I got them backwards here, A and B. So this pivot low should be at or after the 61.8% fib time extension. So if you're taking your fib let's see on here. Let's find it. Fib time extension. So if we went from here and over to our high over here, you would want to see this low at 61.8% of that move or later and get a breakout of the channel around 100%. If this goes and it puts in a low more quickly though, so let's say it comes in, grab red, and it drops more quickly. So we start to see a shift like this. And now our downside move is looking like red here. That's going to make it easier for this to end up breaking down when this pivot is before 50% for the time extension. So if we are using a fib fan on something like this, we would go and we would hook up the fib fan low from over here, the start of our trend, to up here at the top of the trend, as long as this is an average momentum move. So one way you can think of average is, when you're getting these V's and inverse V's, that usually represents average. I normally say that an average trend move will look like a stronger move with a whole bunch of smaller corrections and then, stronger and smaller corrections. So the overall trend here would be average. But another way you could get that is it could have a sharp move, a longer correction, sharp move, longer correction, and up, where your correction is twice the size of the upside move. So if your trend lasts 30 minutes and your correction lasts 60 minutes and it stays in that trend, that's going to be an average trend momentum. So what we want to see here for a fib fan would be if this upside move is average momentum, then we can take our fib fan from the low down here, hook it up to the high here, and we would want to be looking for support at a 76.4% fib fan level. So if we look at the NASDAQ today as an example of that, oops, I'm going to leave that on there actually. I'm just going to go over to our NASDAQ here. So if we look at the NASDAQ, I'm going to erase some of this here. This. Kind of move it over for us. So if we look at our initial uptrend here this afternoon, I'm going to remove the other ones so that it's not confusing. And we are looking at this trend here. You can see that it has these stronger bursts of momentum and then it has a lot of chop in here. So that tells me that it's an average momentum move. So I know that on that, I can go and I can take my low from here for my fib fan and I can drag it up to here. And that means that my buy setups ideally are going to be at the 76.4% fib band. So if I was looking for something like a Phoenix, I would want a two-wave correction coming into that 76.4% fib band. If our impulse move is too strong, though, you might find that if you put your fan on there, that it's not very useful because it is simply too strong. So if you end up with an initial pullback here that goes past 50%, then move your fib fan so that your 61.8% fib fan hooks up with this. I know this can seem like confusing, you guys, when you're first exposed to it, but it's something where once you see that repetition over and over again, it starts to become second nature. And sometimes I go a little bit too fast, especially for newer traders, and then I go too slow for traders that have been trading for a while. But these are just some basic concepts that I use. And I know David's recording this so that you guys can go back and play it again and rewatch it and look at the charts to apply them to yourself. Now, today, like I said, was a trickier day for trading. It's what we call a grinding day. It means there's not a lot of core setups that I trade because it's just offering shorter little extensions of the trend. So what I try to look for are things like, let me see here, see if I can get my other chart to come up for you. I wanted to share with you some of my more recent trades. But here's another example with like the momentum reversing and getting like a shift in the momentum. So if you've got an initial trend move like this, where we have our two waves of the trend, and then you start to see that shift is happening. So compared to the downtrend here, we're getting a little bit of a change in that momentum. If you have three lows that are evenly spaced, this creates a pretty strong buy setup too. So when we're coming into a widening up zone, where we had those measured impulse moves, one of the patterns you can look for in addition to the Phoenix and the Avalanche is something that I call a momentum reversal. So that core pattern has the two waves, and then you get the three pivots, one, two, three, evenly spaced pivots. And then the short is coming off of that third pivot high, or in the case of the ES this afternoon, the three pivot lows, one, two, three. So that is what kind of gave us this little bounce here. There's other reasons as to why this, didn't continue past this. Namely, it pulled back more than 50%. So previous high zone becomes a much stronger resistance level. And usually to get a stronger break, you would then want a secondary correction like this. But by itself, this is another really good pattern to watch for. So if you're looking at securities that have a really extended upside move, if you watch for that three-wave shift here, that can offer some good short opportunities where the widening up zone is basically starting here. So this move from the low to here is a measured move compared to like a previous upside move. So you'll get the initial move over here, we'll call it A, B, same size, and then you can look for these momentum reversals to happen too. So the Phoenix and the Avalanche, those are two patterns you can look for on most of the most of the markets right now, because we are in a widening up zones on so many individual securities right now. Let's see, what are some things that you guys want me to look at as far as different markets? I can pull up some of them to share, to discuss with you on what's going on with them right now. So here's another example, is waiting for you guys to reply, is this is a measured impulse move right here. So you'll notice that this goes into that shifting formation. So we actually have those three highs right here, and then we get little two-wave correction for an avalanche. So you have kind of a combination of the momentum reversal shift is just really steep, and then it went into an avalanche here for the downside move. So that's one really good reversal pattern. And then on gold, let me show you the avalanche that we saw a couple weeks ago. So you can see how that played out. And this is one that I discussed live when it was forming. Just gotta go to the right. Let's see here, add more days on there. And we'll look at some of those that you're posting to here. And the cool thing is here actually, well, that's loading. You can actually see that momentum reversal happening right here too. The difference is that it's a part of staying within this widening up zone. So you've got the measured move here. So now you're starting your widening up zone. And instead of doing a momentum reversal up here with your three highs that would lead to a short, we have an initial pullback, and then you get a little baby momentum reversal right here, where it's kind of helping establish a support level here that's creating the longer range. But this is an avalanche, so this is a good example. You can see that when it broke lower here, A and B are about the same size. And this pivot high was almost exactly at the 61.8% for the price extension. It might have been this pivot that we were looking at. Because I was concerned originally because this was so steep here. And I was a little non-committal to begin with, to start with, because I was like, well, ideally, we would like it to pull over just a little bit more to have a stronger setup. But it was right at it before it ended up doing the breakdown. So it's kind of that verge zone. Here's another momentum reversal, by the way. See the two waves up, 1, 2, and then your three highs. So right there's your short. It's only the first main impulse move off of a low though, so it's harder to do a full trend reversal. It has a shorter little trend reversal, but it doesn't change the bigger trend. It just helps create a bigger correction in there. So this chart of gold here has some of those examples of the strategies that I was sharing with you. Like I said, go back and watch this a couple times, and you'll be able to draw kind of templates for that. So for example, in gold right now, one of the patterns that was a possibility originally is this could have done those three highs and offered a reversal up here. That would have been a momentum reversal. Another possibility would have been, and it actually still could happen, if it goes, has a movement like this and then changes momentum again, with two waves, that would trigger, in this case, a shallow avalanche because this channel is slower than this upside move. And when that forms, that typically leads to a really strong downside move. So that's still a possibility for the future on gold here. Or we could just see this going into either the same amount of time for a correction here. So this is going to be about a do or die point for it to try to offer a third move on the upside. Or if you take this upside move by itself and you doubled it out, that's going to be another do or die spot for a breakout. So this could go into like a bigger two-wave correction like that. And that would give another buy setup over here. So when I'm first looking at a market, I'm basically looking at, hey, where are we at in the trend? What's the momentum look like as we're coming into the current price levels? And what would I want that to look like to give me a buy or a short setup? What pattern can it merge into? And how long would I need to wait for it to try to form that pattern? So let me pull up some of them that you guys are looking at here. And every Friday, I do something called Forward Focus, which is where basically everybody brings me securities that they want to look at and analyze, and I'll do a run through on them on, hey, this is where we're at in the trend. These are the most probable setups. So for example, on the NASDAQ here, if we look back here on the 80,000 tick chart, when this was forming up here, before we ever had a breakdown, What I was telling my traders is that, hey, this is a zone where an avalanche can form, and then we could watch for 3 waves of selling. After the third wave, it's going to be harder to maintain that trend for a fourth move at that same magnitude. If it does continue, we want this to double out so that the correction is about double. And then I told them to look for a measured move here to here, and it got stuck at almost exactly 100%. But this entire sequence, you guys, is something that I was talking about live all the way back here because of recognition of the trend exhaustion over here. So the way that this was already starting to kind of base along right here told me, hey, this can look for a breakdown now at this point. And the most probable breakdown would have 3 waves, primary waves of selling before it would try to shift again. And that shift ended up being the doubling out to then continue the trend. Um, let's clear this here and go pull up. Let's see, MHO. I think I closed my other charts here. Hold on a second. Let's see. I'm going to close out of a couple things here so I can pull that up. I had the trading view charts up for you. Like what David said, I had too many things open all at once. So let's see here. Maybe it's not going to pull up and we'll just need to look at what's going on in the overall market here. Being tricky. I was just on a Zoom webinar too, like a couple of hours ago. No problems then. Shoot. Yeah. Okay, we're gonna close some of these. And hopefully that will allow me to open up our other stuff here. So end task. Okay. And just a second, gang. Sorry about this. Just need to close some other stuff here. Close that PowerPoint too. End process. Yes, I do. I. 'Cause. 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 'C Okay, actually here, this is gonna pull up the PowerPoint. This is, I'm not gonna try to play it as a PowerPoint here, but what I want to share with you here is the chart here. Can see my execution. This is one of my recent trades. You'll notice that measured impulse move. And then right here, it's hard to see it, but there's that little momentum reversal. We actually have a little bit of a shift here too with the three lows, but those are helping kind of turn things around. This is your zone where you would get your avalanche. So here it's tilted, but notice that these corrections are lasting the same amount of time. So when you get that two-way correction after that initial move on the downside, that's another way that your avalanche can form. Well, let's see if I can get those other charts that you guys are asking about. MHO. Oops, too many letters. Oh, this is a nice chart. So you've got that inverse head and shoulders as a continuation play. So in a typical correction, the second wave here is going to be your buy setup, but you'll notice that what's different is the momentum. So with this momentum, if you look at your timing between your lows, if you've got about that same amount of timing, you can get this inverse head and shoulders as a continuation play. The thing you have to be really careful of with something like this, though, is that this initial kind of pop here, whoops, yeah, I don't need that. This initial kind of pop here, that's going to be your first resistance zone. So what can happen is if you've got an inverse head and shoulders as a continuation play, it might only do that measured move. And then basically it takes this, doubles it out, and that's your next do or die spot. So if you're seeing an inverse head and shoulders struggle to get going as a continuation, meaning a continuation over here, have it double out so that your distancing now between these highs is going to be about the same. And that's going to give you another good spot for executing a new trade. In this case, it doesn't matter. It managed to break out and go, but there's going to be a lot of examples of an inverse head and shoulders as a continuation that doesn't work very well. And that's because of this right here. By itself, I'm going to back up and see where we're at on the weekly time frame. So we've got that trend that's kind of increasing the momentum. So you've got strong, stronger, strongest, and this is now your widening up zone. So you're in the very early stages of the widening up zone right now, and there's no clear pattern that's starting to develop yet at this point. So as far as like an investment opportunity or something, usually something like this, I'm just going to stay away from unless I can get it as a continuation on the upside. So if you're starting with a trend that's going like this, if you get a base, especially if it's staying in like this upper third here of this impulse move, then you have a better chance that it could go and do another measured impulse move. So if this went and you've got a pop here and it pauses and it holds in the upper third, your odds are pretty good that it's going to go and do another continuation. The problem you run into is something like this, where it pulls back more than that third, because now the probability of being able to go and break those highs easily becomes a lot lower. So we're in the early stages of the widening up zone where we don't have it holding up strong enough to offer us a high probability continuation move. And there's nothing really for a short side of it right now either. So I would normally just kind of stay away from this. You might see with the original drop something happening kind of like what happened on Dell. So Dell did it with a gap, and then it can shift and go into an avalanche. But since the upside and downside are both so extreme in terms of the momentum, even if it tries to do an avalanche here, the extreme momentum of the downside can make it harder to get a good continuation. So usually what we want to see for an avalanche is for this move here to be average, slightly above, slightly weaker than average momentum in order to get a measured impulse move on the downside. So if it's a really extreme drop and then tries to go into an avalanche, there's a greater risk that it could chop and have a harder time with the continuation. If it has a weak one and then switches and you've got the two-wave correction, that has the best chance of a really strong drop. So your two waves of correction looking like this, where you've got strong momentum, weakest momentum, that is a really good zone for sure. If it is more along the lines of kind of average, then you're just looking for a measured two-wave move back down. So here and here, I'm sorry, these are overlapping. Oops, I erased the wrong one. Let me put it in there. So about average momentum, two-wave correction, two-wave back down. So your drops are going to be about the same size. So here, this is going to be trickier. So I would, if this was, let's see what it looks like intraday. I would normally just stick to a day trading on this, but it might not be. Yeah, it's not liquid enough here to get a good setup on it. You can actually still see the patterns on this. Like if we pulled this onto a line chart, you'd see the extreme drop and then the three lows here for the momentum reversal, and then it goes into a phoenix. In this case, it's a megaphone phoenix. And then you even have the two-wave drop here, and then it has the three lows as well. And then this goes into a tilted phoenix. You can see the two waves of correction here. This would be easier to see on a line chart, but it still has those things in it. This goes into a bigger phoenix here. Call this a checkmark phoenix. Checkmark phoenix has a strong upside move, strong downside move, comes back up, then does a two-wave correction and then continues. So that's the two waves of correction here. So intraday, this isn't really a good zone for a new setup, and it's not something you could really day trade, but the patterns are still there in it. So you've got that extreme move, goes into the widening up zone, you get the shift in the momentum here, but you don't know that this is going to go into a momentum reversal. It could have easily gone into like the two waves up and then done a phoenix. So you have to wait until you got more development with the pattern. So you need to have like the three lows with the even spacing or comparable spacing in order to give you a buy setup. You would need for this to have a stronger rally and then a shallower two-wave correction to give you a buy setup for a phoenix. So a lot of the securities like this one, MHO on a daily time frame, they're not at a good zone for either one of those yet. And they're more of like a wait and see at this point. Let's look at the MARA. We have a little bit of time here. So here's a good one where you can see the Phoenix formation, and it did have an extreme move to start with. So when it did the two-wave correction here, and it actually has a little check mark as a buy setup here, you can see that this doesn't get the same momentum coming out of the Phoenix as it does going into it. And it could have ended up being even weaker just because of this extreme impulse move here. So this one does manage to go and gain momentum, but the probability is not as strong as it would be if this was a little bit weaker. And then you would be looking at a measured move here, to here as a target level. With this, it's going and gaining some momentum, so it manages to go further than a measured move. But the initial start is slower because of this initial strength over here. Let's go look at the bigger chart on this. Look at our daily. So this is a good example where the widening up zone's not really going into a great pattern. You might have gotten a little bit of an avalanche in here, but overall, it's a much bigger trading range, widening up zone. So you've got that extreme impulse move. Here we have one where you've got the three waves. So you've got a widening up zone here, but it does that two-wave shift where you get a shallower avalanche and is able to go and drop more quickly. So you've got in here, you've got the two-wave drop here, and then you've got a two-wave move here. So you've got strong upside, weaker, weaker, faster drop. That's what helped turn this around here. This one, you don't have enough of a shift in that momentum. You've got really strong upside, really strong downside, both substantially stronger than average. So it's making subsequent patterns determining, hey, do I want to short here or do I want to buy here? It's more risky. So at this point, what you need to watch for is some sort of a shift within this range. So for example, here you had the shift again for the Phoenix that allowed for a stronger bounce because it's slower to start with, slower for the correction, stronger bounce. If this could go and shift like this, then we've got this rounding off that's happening, and you could get a bigger avalanche trying to form that can lead to another downside move. But this is a pretty typical impulse move size where you get the same momentum, the same size type of move. So that makes this a really good support level. You'll also notice that this pulled up more than 50% of the drop. So by doing that, you've got a stronger support level at a previous low too. So it's harder to say, oh, I'm really going to look for continuation at this point. I would normally wait until I have a secondary correction. So this would be the first correction. This would be the secondary correction. Could it shift into something else? Yes, absolutely. But this would still give me a do or die point for a short if this goes into that range here for a couple weeks. But it would need to go into a range for a couple weeks to give that setup. So we're at the very early stages again of another widening up zone on a smaller time frame because this is a pretty average impulse move size here. And it is stronger than average momentum. So on a smaller scale, if this had like a move like that, you could get a Phoenix, but it had a really extreme drop or extreme bounce, a bit more than a third. So trying to get like a nice continuation like this, where this serves as like a pause and then a stronger drop, that's going to be harder because it bounced too much off of that previous low. So it's easier for it to go into a longer range right now. Let's look at the weekly. And the weekly doesn't have a good setup either. You've got a little bit of a rounding off over here, but not enough of a bounce. So it's kind of treating this like a lot of like pump and dumper type of stocks look like this. Uh, they become more interesting when you see things like here where the momentum is really shifting. You get a pop and then you get like a Phoenix formation. That can become a really strong setup. You've got a Phoenix over here too, where it tried to go here first, where you see a little bit of a shift in the momentum. So it did the two-wave impulse move, a little bit of shift in momentum, and tried to do a Phoenix here. Couldn't really get going enough because it had pulled back more than 50%. So it doubled it out. So that doubling out then allowed this to pop again. and that's your next do or die spot. So it's the same amount of time development. If you look at the distance between the highs here, it's trying to break right at about that 100% extension. And this pivot low is at or after a 61.8% price extension. So if we translated that and looked over here, it would be like if this popped up here, went and doubled out, that would be a similar type of zone because you have to have technically two waves of upside here. What I don't like about this to try to go into a Phoenix is when the two waves of upside, I like them to have the same momentum. So if it is slower and then faster and then tries to go into a Phoenix, it's not usually as strong of a Phoenix. So it does increase the downside risk on this. It's going to make it harder for that to develop into a stronger setup later on. And more something that would be like a better strategy, which really would be detrimental for bulls, would be for this to come down and do like another move down here where it could end up shifting again. And that could provide the opportunity for another setup. If you actually look at COVID charts going into the fall of like the spring is when we had it hit, and then you go and you look into the fall and into the winter. Uh, of the next year, the year where we are all stuck in quarantine. That's what the COVID charts look like. And they predicted another surge because they had that kind of rounding off. So this would be a good pattern to watch for on something like that for it to try to get going again later on. All right, you guys. Thank you for joining me. Sorry about like a little bit of the technical difficulties we had going on. If you want to learn more about my system of market analysis in a much more structured way, I have a course that is a 5-day mentoring event, and it is only $100. So I make my living on trading, but I find that teaching actually greatly helps my trading to be able to actually go and explain what I'm doing. And if you really know something, you should be able to explain it to somebody else. And it helps develop your expertise. So if you'd like to learn more about my building blocks of price development, things like the trend development and momentum, and how they work together to create strategies, then this would be the one that I would highly recommend you starting with. And it's going to go into a lot of the psychological side of trading as well. So you're looking at trader psychology, how to overcome a lot of the obstacles as it applies to psychology, things that I've had to overcome over the years, and where I can start to recognize, ooh, I'm kind of not in my trading zone anymore. They're going to be big clues. And I also share with you one of my favorite strategies for the reversals. It goes into templates with a list of the pros and cons for them. So you can put them together and look at a lot of different examples of it as well. So you've got step-by-step walkthrough of a lot of the trades, live trades and analysis that was happening at the time that I did the class too. But it's now available all on demand. So go and take a look at that. And thank you again for joining me. And thank you, David, for having me. And my apologies again for kind of like the rough technical start there. But I hope you guys learned a lot, especially you go by and watch it again.